Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, partner and portfolio manager at KJH Investors. Thank you for joining us on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I have Joel Clark joining me today. Joel is CEO of KJH. It's great to be together again, Joel, on our first KJH Insights podcast of 2025. Welcome, Joel.
Yeah, welcome, Sarah, and Happy New Year.
So, Joel, let's reflect on the end of 2024 and then talk about 2025 for our listeners. So 2024 was a good year for markets broadly, really strong year across the board, but it didn't end the way we normally expect it to end with a Santa Claus rally, which is the term that defines the last 5 days of the year. That never really arrived. So let's talk a little bit about the end of 2024 before we jump into 2025.
Yeah, and I think you pointed out the important part, which is risk assets did extremely well. In 24, the S&P was up 25%. The Mag 7 was over half of that. A continuation and a trend that you and I have talked about on these podcasts literally for the last 3 to 4 years. So there was really no change. But you're right, the Santa Claus rally into year end did not happen. We had a correction, which in the moment was a bit of a surprise because there wasn't a lot of macro news or there wasn't a catalyst or an event. But as we've moved into January, it's become clear it's been because of bond yields. We've had a really big backup in bond yields, especially in the US. And of course, we're getting to that point of the 10-year being around 5%, which markets get quite spooked about. And so that's really the reason why we've had a correction, in the last few weeks of 24, but into the first 2 weeks of 25.
Yeah, so let's talk about 2025. There's some definite themes emerging around geopolitics and around the market itself. And a few questions are coming up from our clients, mainly around the politics, so Trump coming into office and Trudeau resigning, but also around two issues, which is the market richly priced since it's trading at now a 20-time multiple? And also, has the Fed actually conquered inflation and what's next? So can you tell us what are some of the themes that are on your mind? And then let's dive in a little bit around those issues.
Sure. So let's start with the economy. The economy is certainly in the US, largest economy in the world, is solid. It's growing. GDP should be around probably 3% this year. On Friday, you had the jobs numbers come in. They were strong. The unemployment rate dropped. So the basis for what drives markets over the medium to long term, being the economy, is on very solid footing at the moment. Okay, so that's the first thing. Now, commensurate with that, because the economy is doing well, inflation has reaccelerated. And it reaccelerated because A, like I mentioned, the economy is doing well, but B, they dropped interest rates at the front end, which has sort of re-sparked inflation. So at the moment, we have an economic picture where growth and inflation are reaccelerating. And with that, of course, has come higher bond yields because they follow inflation. And so the 10-year hit 3.8% in July, August. And as I mentioned a few minutes ago, that's now broaching 5%. So we've had a pretty significant move in bond yields as inflation has reaccelerated and growth is reaccelerating. So there's a few cross currents, of course, because on the one hand, you don't have economy that's falling apart, but on the other hand, you have inflation, which we've always talked about, sort of declined to a higher low and is now reaccelerating, which has the bond market worried. So there's a bit of uncertainty at the moment with those sort of big macro drivers, and then overlay that with your comments on the political situation. So first and foremost, we have Trump coming in on the 20th, and he's been pretty active and pretty vocal with some outlandish things like the Gulf of America and taking over Greenland and governor of Canada. And, it's really hard to parse through what he's serious about, what he's not, and how it's all going to play out. And so typically cooler heads would prevail, but not with someone like Trump and not with a situation where the House and the Senate are in Republican hands and they can make significant changes more easily. So there's a lot of cross currents at the moment. I wish I had all the answers. They will become clear a bit over time, but that's why there's volatility in the first few weeks and let things settle down. And then I guess lastly, your comment about valuations is an important one. We're at the fourth highest point in history by way of valuations. Typically at this point, forward returns are muted. And so we have that to contend with. So there's a lot going on. But first and foremost, we do have an economy that's on solid footing.
Let's talk about that, the economy and inflation. What do you think the Fed's next move will be?
Their next move will be nothing. I do not think they'll drop rates any further because if they do, it risks the bond market backing up even further, which they can't afford. So I think the Fed is done. And I think that's part of what the market is digesting. They got pretty ahead of themselves back in September when we thought we'd have 4 or 5 rate cuts, but that's just simply not going to happen.
And is the massive public deficit playing into the bond yields at all?
Yeah, it is. And I think that's another concern with the market, the cost of funding government obligations or obligations anywhere, whether it's a corporation or a personal obligation. With yields backing up, things just simply cost more money and valuations come down. So pretty simple.
Let's turn to this conversation around the S&P and the valuation of the S&P. So trading at around 20, 21 times right now. Break that down for us. We've talked a lot about the bifurcation and S&P 500 versus S&P 493. What's driving that multiple? Are you worried about tech stocks?
Yeah, I mean, a few weeks after Trump won, you had significant improvement in breadth. And what I mean by breadth is more than just 7 stocks started to really work out, which is good because most people don't concentrate their wealth in 7 stocks. So everyone's fairly diversified. So those who were more diversified were starting to benefit from a broadening out of the market. And the perspective was, well, Trump's coming in, make America great again. These companies are more geared to simply the 4 walls of America versus sort of multinational. So this would be highly beneficial. Now that has unwound. It's hard to know why, if it's the tariff rhetoric, but we do have a valuation discrepancy between the Mag 7. They're obviously in the 30 times plus valuation and the balance of the market's lower. That's where you get the average. But some of these larger companies deserve a higher valuation. They're growing quicker. They don't have debt. They have capital structures that are very attractive. They generate free cash flow. It's not just to say that the market's rich is enough, so therefore that's the end of a cycle. But, typically there's a catalyst that causes a downturn. But this could just be a normal course correction and things are resetting based on a stronger economy and higher inflation. And like many corrections we've seen over the last 2 to 3 years, off we go and potentially make new highs mid to late year.
What do we watch for? What indicates to us that we are coming towards a top or that it's a time to sort of start thinking about the idea that the market's getting too frothy?
Just that, what is typically a blow off top, endless amounts of speculation, parabolic moves in the market, complete risk on, blind risk on is typically one of the signs that you see. We haven't had that yet. I mean, it's not to say that that's always the case in a topping pattern. There's other examples of a 1.5 year, 2 year churning topping process where the market doesn't really go anywhere and sort of brings everyone in at the top and sort of frustrates them. So you have sort of 2 scenarios, a blow off top or a long, elongated sort of churning process with no progress.
Yeah, yeah. And I think, as you've already said, you're also looking at some of the tightening forces, like yields going up, and you're watching that closely.
Yeah, for sure. And so is the market.
Yeah. Now, one thing we haven't talked about is the dollar. The US dollar is very strong. So talk to us about that.
Yes, that's a very good point. Because of the relative higher yields in the US versus economies around the world, such as Canada, such as China and Europe, who are not doing as well, you have a very big yield differential. And because of that, it's attracting money to seek the US dollar to get higher yields. And so to get higher yields, you have to buy US dollars. So we've had a very epic run in the US dollar. And that's at some point that'll be a headwind. And the government has sort of a choice to either let the bond market suffer or to let the currency market suffer. And so at some point, they're going to get worried about the bond market and the losses, and they'll have to take the wind out of the US currency.
And so, thinking about the tailwinds and headwinds, how are you thinking about allocation? I think it might be a good time, given that this is our first podcast of 2025, to talk about the idea of our all weather strategy and just that we actually don't try to call markets and we believe on the equity side of investing in best in class businesses and really trying to position portfolios that will do well in various types of markets. So, talk a little bit about asset allocation and how, given the headline news and all of these different issues we've talked about, we're thinking about managing risk, but also driving return.
Yeah. So, it is very hard to call markets. So you might get it right once, but it's very hard to make it a repeatable process. So our philosophy at the firm for allocating capital is to take more of an all seasons approach, a balance between equity and credit. And like you said, on the equity side, we focus on a diversified basket of the best companies in the world that can thrive in bad times and good times. And that's worked out very well for us over time. Now, what's unique about today's environment versus, say, 5, 10 years ago when rates were zero is that balanced portfolio and credit is producing high absolute returns. And so you don't have to make those large calls because you are getting equity-like returns in the credit market. And credit generally is less risk or less volatility than equity. So we're going into the third year where I'd say that sort of balance between credit, and when I say credit, sort of we hedge out interest rate risk in a lot of instances, and equities is probably a good spot again. And it's, I can give you a bullish case for this year and I can give you a bearish case, and it's really hard to know. And we are getting a correction here. So a few more days of this, and there's lots of opportunity, especially with, if you take the positive side of Trump, who's sort of pro-business, deregulation, there's things that he can do that are good for the US economy and the market. And so, you might get a very nice entry point in the next week, actually, to take a bit more risk. So,
Yeah, and what are those things? Most people believe that Trump 2.0 and the tariffs he's talking about, especially against Canada, are not good for markets. So what would be some of the policies that Trump is talking about that might be positive?
well, a more welcomed M&A environment, more welcomed IPO environment, not a lot of red tape on mergers and acquisitions, takeovers. If you have a government that is not putting up roadblocks, then companies are willing to invest in their business and take medium to long-term risk. And that's what they're looking for. So you could get a lot of capital activity. And I think you have to focus on, the US is a large economy into itself. And so focus on those businesses that do well within the borders of the US.
I think that's a really good point. I think, there is so much. Oftentimes we focus on so much of the things that could go wrong. And there are some areas that really might do well under all of this. So, Joel, I think we're coming to a close here. Is there anything else you want to leave or any nuggets you want to leave with our listeners?
No, I think continuation from last year into this year, we're focused on balanced portfolios, sticking to our knitting of buying best in class businesses. Earnings should grow this year. The economy should grow. You might not have equity returns like 25% like we saw in the S&P this year, but it should be a pretty good year barring some extraneous event. So I'm quite encouraged, but balanced. There's always risks that we have to pay attention to. So I think it's I'm encouraged for sure about this year.
Yeah, I think it's almost cautiously optimistic, right? I think
Yeah.
I think the investment team, there's definitely a lot of shifts. But as Peter, our CIO, always says, is that profits drive markets, not politics.
Yeah, exactly.
Yeah. So watching for some opportunities, recognizing that there's volatilities ahead. I think that's really our main message right now as we head into 2025. Is that right?
Yeah, exactly. Yep.
Okay, well, thank you, Joel. And I think that's it for our time today. Thank you, as always, for your insights and for sharing your views from the investment team with us today. And thank you to our listeners. We'll be back next month with another issue of KJH Insights, focusing on our perspective of the market. Wishing you all a very happy new year. And as a reminder, if you have any questions about your portfolio, please reach out to anyone on the investment team or private client team. We'll continue to provide you with commentaries and updates as the market and the market narrative unfolds. All of those are available on our website at kjharrison.com. Hope everyone has a good month, and we look forward to speaking to you again soon.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.